Thanks so much for tuning into today's Talking Point. I'm your host, Neeraj Shah. Our guest today is Shiv Puri, Needs Known Production. Shiv, great having you. Thanks for taking the time out.
Having me.
Shiv, divergent trends, if you will. I mean, we've kind of completed 7 months, stepping into August, uh, earnings season almost behind, and you could say that rather uneventful in that it's kind of played out mostly as per expectations. What's your sense about the pulls and pressures that markets are facing currently?
Well, I think coming into this year, there was a lot of skepticism whether earnings would come through if we enter into a recession globally. And it's been quite clear that global growth has been reasonably strong, especially in the US. And that despite the banking crisis that happened out there, it's been very resilient. And India has been resilient as well. So I think where we are today has sort of played out, but there was a lot of concern at the start of the year. And now that's behind us, and we sort of look a bit forward with inflation having peaked globally. We're seeing supply chains ease up. We're seeing raw material prices largely ease up, especially from the trajectory that they were on. And therefore, if interest rate hikes are largely behind us, the outlook for both earnings and equities should look pretty strong going forward.
How much of a role, Shiv, would flows play in this? Because, I mean, I know that the tide turned somewhere around March 30th, but we've put in 3 strong months of large foreign inflows behind us now. We're just starting to wobble a little bit in the last few days of the month of July. Can flows stay constant, and will that prop the markets higher? Or could foreign liquidity dry up because of the central banking commentary or however, or the valuations? And will that play spoil sport to our levels as we stand currently?
I have a feeling, Neeraj, this time it feels a little different. I was just in the US and I spent 6-7 weeks out there. The first time I went was 2003. So I've seen a few cycles, and this feels that it's a little bit more structural in nature. And if we just rewind for a second, in 2003 to 2007, 8, we saw very strong flows until, of course, the GFC happened. And then for 4 or 5 years, markets and flows were pretty lackluster. And then we had a change in government, and optimism and flows picked up again around the 2014 timeframe for 3 or 4 years, as did markets. And then, we had a period of consolidation, of reforms, of banking sector cleanup, followed right into COVID. And having come out of this 4 or 5 year cycle again, it feels that this time it's not just about the last few months. I would say some of the strong flows of the last few months are perhaps also a little bit of a correction of the significant outflows we saw last year. And just the realization that in a world where growth is hard to come by, 6.5% real GDP growth is very attractive, especially for an economy that's 2.5 trillion plus. So I think when we look at flows, it feels a lot more structural than it has in the past, and also aligns very well with the geopolitical situation that India finds itself in, which is very advantageous compared to some of the other countries in the world.
So, do you reckon, Shiv, therefore, that flows, I mean, what would happen on a month basis here and there is fine, but by and large, as things stand, irrespective of what central banks' commentary is, would you reckon that the better part of the next 9 months of the calendar left, or 8 months of the calendar left, we will by and large have inflows from the global side as well?
Yeah, I think I would say perhaps even the better part of the next few years, assuming that we have continuity in government next year as is being expected. I think the flows this time would be a lot more structural. One of the other things that's happened in the past from global allocators is they've looked at the S&P 500 and they said, 50% of S&P 500 revenues comes from overseas. We get all the diversification we want. So why bother looking anywhere outside the US? But if you look at the S&P 493, which is outside of the top 7 tech companies, that's when MSCI India or some of the other markets have performed really well relatively. And so, some of these, there's a realization perhaps that some of these big tech companies that are $2.5 and $3 trillion in market cap, which can go up, but they may not have that same kind of upside that they've had over the last decade or so. And so, if one needs to look at any sort of diversification outside of the S&P, there are very few emerging markets that give them that option. And so, when I look at it, even that sort of argument that the S&P was a good enough proxy will start waning, and I think that will help drive more flows into places like India.
That's a nice insight. Thanks for that, Shiv. So let me try and understand this. If assuming that domestic flows, its ceteris paribus doesn't change too much, global flows we are saying largely could be structural and not cyclical. What does it benefit then? I mean, typically the behavior of the market or the thought of the market would be that the large dominant sectors will be the ones which will get a lot of flows because flows might be passive in nature. At the same time, there's this argument that a lot of newer pockets which have now come to the fore in the last 3 to 4 years now have some size relative to what they were 3-4 years ago. And therefore, because they are so compelling a story, they might attract money as well. What is your sense about what themes therefore stand out, keeping in mind the idea is to take advantage of the flows that are coming into India?
Yeah, I think the themes in India have largely been consistent over the last 20 years. Not much has changed, whether it's in financialization, consumer, and that includes everything the consumer would spend money on, and some part of the infrastructure build out, although that is much harder to play. I think what will benefit will be both sides really, but what should probably see more of a disproportionate gain might be companies that had high foreign ownership, which had a disproportionate negative impact last year. Certain financial institutions, etc., that have high foreign ownership that saw a lot of selling, and perhaps that might get reversed, during the next year or so.
Okay, can I probe some of these points a bit more? Let me take financials, for example, Shiv. How do you look at that pocket? Because the belief at the start of the year was that, hey, let's start looking at NBFCs versus banks simply because the rate trajectory might be lower. The belief in the last 3 years has been that while larger banks have done and larger financials have done what they have done, is it time to look at regional plays, niche plays, because the growth rate might be high because of the base effect. And some of those theories also have been thwarted. So as things stand, how do you look at financials?
Well, first I would say is that financials, whether it's banks or NBFCs, vast majority of them, the balance sheets are in pristine condition, and they have been for a little while. And the reason is, there's been years of previous cleanups that have happened, and during COVID, most financial institutions over-provisioned. And not intentionally, but just the outcome post-COVID wasn't that bad. So as a result, the balance sheets are immaculate pretty much across the board. The second thing I'd say is that there is, the demand side of the story is structural, whether it's mortgages, whether it's personal loans, etc. And I still feel that there is a very long runway to go. I know people look at certain pockets and say, maybe there's a little exuberance in personal lending, unsecured personal lending, or there's too much reckless lending happening here or there. But I think one needs to just step back and look at economies globally. And India is starting from such a low base still that there's a long way to go before we reach any of the penetration levels that happen in the Western world. But I think the next few years is going to be a little more interesting in that in the past, and I would say 8-10 years ago, you would see small banks be able to grow faster. They're working on smaller bases, and therefore they were able to grow faster and be very profitable. But I think now increasingly more scale is starting to matter. because you need scale in order to spend on technology, in order to be the lowest cost provider of capital, whether it's through cost of funds or through operational expense. And also, if you're a dominant regional bank in one part of the country, sometimes for the big banks, it was difficult to build the distribution network over there to reach there. But now through technology and digitization, there are much easier ways to reach that geography and capture the customer. So I think for the smaller players, they will have to think differently. They'll have to do things differently. The big banks have, or the big NBFCs have got their game and their act together, and scale is going to matter. I mean, you've seen the largest bank in India, expand their branch network by 25% in the last 1 year, and that is really to build out their low cost deposits. And with that kind of brand name and that kind of push, it's going to marginalize some of the smaller players. So I think the whole notion that the big can't grow or can't scale will not happen, and you will see some of these strong scaled up banks who have the ability to attract low cost deposits, to spend on technology. They obviously have great risk management practices, do better. They obviously have great risk management practices, do better in the coming years.
I mean, I'm just using these names as illustrations, but there is a Bajaj Finance which is moving through the quarters as if it is still a young gun. There's HDFC combined, which is a very large one. Jio, not only in financial services, pure play lending, they've announced this whole Jio BlackRock asset management piece as well. So there are some large behemoths out there. You reckon that the prospects of the larger ones over the course of the next 3-4 years, growth-wise, might be stronger than some of the regional ones, smaller regional ones?
Yeah, I think so. And just for the reasons that I just highlighted, in some cases, I think we perhaps look at some of the larger banks and say, it's 30 billion, 40 billion loan book, and therefore how much can it grow from here? Or, in the case of the largest bank, even 100 billion. But we forget that it's a $2.5+ trillion economy, perhaps, that's growing at 11-12% nominal, and credit penetration is low. And it's not fair to compare certain sectors in India directly to say what's happening, in the US. In the US, there's 4,500 banks. In India, I think there are 23 or 24 registered banks, of which a handful of scalable private sector banks. So the competitive dynamics, the market structures are very, very different, and it's not impossible to have the market cap of a bank in India exceed the market cap of a bank in the US.
That would be something. We fifth, right, for the largest bank, fifth largest in the world. It'll be interesting to see what happens in the course of the next few years. Shiv, because you're perched outside India in Singapore, I would love to understand how you think about the consumer subject as well. There are a bunch of discretionary consumption promoters who I have spoken in the last 6 months in long format conversations. And a common theme that comes out in all of those conversations, especially in QSRs, but others as well, is about look at what's happened across the world and look at what's happening in India. In some cases, we are even smaller than what's happened to those pockets in countries like Brazil and Mexico, despite the fact that even on the economic size or the population size, they are much smaller in select cases. I would love to understand how you think about that argument, and does it make it a long-term investable story in India, discretionary consumption?
Yeah, I mean, discretionary consumption for the last 2 decades and probably for the next 2 decades will be a, structural story in India. And I think maybe perhaps what's different is, in the 2004, 5, 6, people projected the consumer discretionary market size in terms of number of consumers to be larger than they actually are. And that's taken a little bit longer for disposable income to really percolate down consumers. But but that number is increasing every year. Disposable income is increasing every year. And I think that is going to continue. What we're seeing globally, not just in India, is a shift in spend. So spend is more targeted towards services still post-COVID. And therefore, you're seeing, hotel companies, especially some of the nicer hotel companies globally, do really well, whereas spend on certain other physical products has been a little lackluster. We're seeing in India and globally premiumization to be quite significant. So the higher end products are doing well, whereas mass market products yet are doing okay. But I think in India, one of the things that we're starting to see of late, and it's in the commentary of some of the companies out there, is that rural seems to be turning now. They've had a period of low growth, high inflation, and that seems to have impacted, obviously, disposable income in the rural part of the country. Unlike the US, this time India behaved very responsibly from a fiscal and monetary standpoint, and that's evident in the macro and inflation numbers. But there was a burden on consumption spend from the rural part of the country, which seems to be now turning the corner. And hopefully over the next couple of years, you'll see not only urban, but rural spend also pick up, which I think will help the mass discretionary and the mass consumption bucket of the country.
Okay, and just tactically, Shiv, the idea was that the belief was that we'll see inflationary pressures taper off in the second half, which might help the staples space as well, coupled with the fact that rural seems to be, I don't know if it's bottoming out, but the commentary from companies seems to suggest that rural is starting to revive a little bit. But the raw material input or the commodity cost downtrend piece might be under a question because of what's happening to fruit currently, if China were to open up stimulus, so on and so forth. So how do you look at staples tactically? I'm not talking about the long term. Here, I'm requesting you to talk about the very short term.
Well, I think tactically, the issue will be a little bit more on the revenue and the top line front rather than the cost basis, because on the cost side, they're going to be lapping a very favorable base. So the cost structure is still going to be okay. Last year, if you remember, there was a peak of the cost pressures that they faced. But on the revenue side, what is happening is that once raw material pricing eases, you see a lot of new competitors, unorganized players who traditionally were not in the market or vacated the market during high raw materials come back in. And so the big consumer and discretionary companies will increase ad spend, will not be able to raise prices as much as they would. And volume growth in terms of increased consumption that would happen, which had slowed down because of the rapid increase in prices, that takes time to catch up. That takes a few quarters to catch up. So I think over the next 6 months, you could see some pressure on volume and value growth rather than on the cost side.
Got it. Shiv, I've asked you a few things on my own. I would love to understand from you, relative to the market weightage that might be there, where is it that you are most constructive on? I mean, you spoke about financials, but financials is anyways a large weightage. So I don't know if you are very large overweight there. So relative to the markets, where is it that you are more constructive?
Well, I would say that, the areas that we look at, anywhere is predominantly financials, consumer, healthcare, and tech. And in the Indian context, that would be IT services. So those will be the only 4 areas. I don't really think we think in terms of overweight or underweight, but there's enough opportunity, I think, in those 4 areas in emerging markets and in India.
Got it. So just one final question then, healthcare. Until 6 months ago, healthcare pharma was only spoken about for the non-US exposed companies. The last 3 months have seen some bit of exposure or some bit of preference even for those. The commentary is looking okay on the pricing erosion stability in the US as well. Have you changed allocations to healthcare from what they were? And what is it that you like? What is it that you don't within this bucket in India?
So I think in India, one of the interesting areas is still the whole hospital space, which is under the broader theme of healthcare. It's not specifically pharma, of course. But again, there's been a very structural change, and to the point that I was making at the start, which is scale is starting to matter. You're starting to see some of the larger operators do substantially better than standalone facilities, and therefore the good operators who have the scale, who have the brand, who are able to attract the best medical professionals to work there, who are able to therefore attract the best high paying customers, sort of building a little bit of a virtuous effect over the last few years that I think is only going to get stronger. And if they do have the ability to perhaps engage in sensible acquisitions of standalone facilities that are of some size and scale and strategic value, there is the option to build a large franchise in that area. So I think the overinvestment and the era of lack of differentiation in that space that existed 7, 8, 10 years ago is starting to consolidate and is still pretty interesting.
Got it. Shiv Puri, pleasure talking to you. Thank you for taking the time out and being with us today, and look forward to having more often on the platform.
Thank you, Neeraj. Appreciate being here.
Viewers, thanks for tuning into this edition of The Talking.